Hey, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Wednesday, July 20th, 2022. Hope you're all having a great week. Beautiful weather outside. Hopefully you're getting an opportunity to enjoy all that summer has to offer. Markets continue to heat up as we're now past the halfway point of July, which has left a lot of investors, institutional investors, and market pundits puzzled because as we came into July with a Federal Reserve meeting about 2.5 weeks out and in anticipation of another interest rate increase, the general consensus in the market was that the market was surely headed lower. And what we know about financial markets is when everybody is sure about one thing, the market is going to do something else. So we've started to see a very nice rally build here since the beginning of July. Some momentum starting to build this week. Looking at the right areas of the market are starting to lead. We're going to go through that with you here today. And again, looking for that momentum for this market to carry through and try to reclaim some recent highs. So first, let's take a look at the market. We do see some things that are happening that are very constructive in this market, right? And this is just a view of the, NASDAQ Composite Index since the beginning of 2022. And what I've highlighted here is a series of what we call higher lows, okay? And in technical analysis, this is a very constructive thing to see, or it's set up to see in the charts as we scan through them. And what a higher low is exactly what it sounds like. As markets work through volatile swings, we look for each cycle low to be higher than the last one, and that's positive. That means the markets are trying to build a base very different than if we look at the earlier parts of the year, right? Markets would make a low, bounce off that low, right, and think we were in business, right? Markets ready to move higher, and then markets will go make a new low, right, or a lower low, lower than the previous one, right? So what we're starting to see here, again, really since the early June, that swoon that we saw in early June where markets fell a lot in a short period of time, we believe that the major indexes have likely started to carve out a bottom off these levels, and that's starting to be confirmed with some higher lows. Also, importantly, we broke through to yesterday and today in a big way. We broke through this overhead resistance, which had really just acted as a brick wall every time the markets moved up into this level. So good to see that markets have broken above this level. Again, we know still a lot of work to be done to get back to those January 4th all-time high levels. But this is how bases look. This is how things in the market start to build some consolidation and a base to act as a springboard. So that's a good thing. Also fueling some of the momentum in the market, right, is the recent shift in media coverage. Now we know that the media and their coverage of the markets really has no bearing on what's actually going on in the markets, but it can influence investors and retail traders. So for quite some time, right, the media was focusing on the bear market that is, the crash that is, and now all of a sudden, the media is starting to throw around the idea that maybe the bottom is in. Now, again, we're not operating an investment strategy based on suggestions from the media, but this type of media shift in the narrative will fuel investor sentiment across the market as people start to get a feel for and hope that the bottom is in the market. So again, it takes more than hope, right? Hope is not a strategy, but when you see the technicals in the market starting to align with a shift in the media narrative, that is a good thing as well. Now, what we've talked about some time, and I want to just move myself so we can see here. What we've talked about some time is our expectations, right? We know the market came down due to interest rates going extremely high and compressions in multiples of the market. But we've talked about for some time that at some point the Fed pivot would come, right? That pivot from raising rates to cutting rates, or maybe the initial pivot will be from raising rates to just pausing on rates. When that coincides with a drop in inflation expectations, this market will soar, okay? And when we look at, so what you're looking at here, I know this is a little bit of a complex chart, but basically just let's take a look at the top half of the chart here. What we're illustrating is this red dotted line is what we call the Fed rate cycle maximum, right? So where previous instances where the Fed was in a tightening cycle or a hiking cycle, where did they get to before reversing course? And it tends to be right along this bell curve here. And specifically, or most recently, remember what happened in the fall of 2018 into early 2019. Markets came right into the same level. The expectations for Fed rate cycle maximums came right into this level. And before you knew it, we were cutting rates and it was off to the races for the markets yet again. So look where we are, right? We've come right in to that overhead resistance on the Fed rate tightening cycle. And we think this is going to align in the next month or two with inflation starting to fall, right? And if you get those two events coming together, the Fed will know that they don't need to hike interest rates as fast or really at all anymore, and markets will be sure to like it. Now, we do think that the market is starting to figure this out. That's why you're starting to see substantial outperformance in a lot of growth assets, right? The areas of the market that had just been absolutely crushed. And really that is kind of the point, right, that we're trying to drive home here, is that when sentiment around stocks, whether it's the entire market or a group of stocks, hits dire lows, there's no sellers left, folks, right? There's really nobody left to sell these assets. And this is when these these assets, and particularly right now growth assets, they start to build their basis. Now, how did we know, or how did we feel, right? What gave us the confidence that growth assets were starting to build their basis? And reality was that when we looked at the markets, right, when we looked at the NASDAQ, the weakness in early June in the indexes was not confirmed by individual growth stocks. And I'll just give you an example of that, right? So keep this in mind, right? Markets get weak into early June. Let's bring up, our friend Chewy for a second, okay? You look at the markets were weak in early June. Chewy's weakness ended in the end of May, right? So the growth stocks have started to outperform really since May 12th, right? We spoke about this in our last video. But the indexes got weak in early June and growth stocks did not follow. So that would be a confirmation bias for us that we think that these stocks are building a basis and they're starting to act in a way that would suggest that there could be some explosive moves coming. Now let's just go back for a second to the NASDAQ there. All right. And also, folks, one thing you have to remember, right, that doesn't really get talked about a lot is with 70 to 90% drawdowns in a lot of these growth stocks already behind us, the crash is in the rearview mirror. The pain has been felt. We've already gone through hell. Now it's time to come back from it, right? So risk reward from these levels is substantially skewed towards reward away from risk, right? Because most of these stocks have been through the ringer already, and now they are starting to show signs of life. And as soon as that CPI, right, that inflationary reading comes off and or the Fed pivots, right? If we get both of them, watch out. But as soon as one or the other happens, there is likely to be an explosive rally in the growth side of this market, and that is what we are positioning for. So the question we've got a lot is, this has been a very deep drawdown. Is it going to take us, some odd number of years to get back from it? No, we expect that when this pivot comes and when CPI or inflation rolls over, there is an explosive rally waiting for us on the other side. Now, yes, it has taken longer to get to this pivot, and it has taken longer for inflation to peak out than we initially modeled for, but that doesn't mean that the destination has changed. The path to get there may have just changed a bit. And really, throughout history, when we look at, investors who bought shares through some of these major declines, these 70 to 90% tech declines that you see, and really this goes back in 1929, 1930, 1974, 1987, 2000 through 02, 08 through 09, and the March 2020 COVID crash, right? Those investors that stepped in and bought quality companies in those periods of times made a fortune in the years to come in the ensuing rallies that came out of those bust periods. So folks, this time is not different. This too shall pass. This crisis is going to be a massive opportunity on the other side. I know I've been saying that for quite some time, but we mean it, we believe it, we have the conviction in it, and the market evidence is starting to show up that supports our case. So remains to be seen, right? Can we continue this momentum, or will this rally fail like many others? But we're starting to see the right signs in the right places that give us a good feeling about what's coming in the second half of this year. And also, folks, this is important to make note of here. The rally that has come about here is being led in the right places, okay? And if you look at this is our heat map, over the last month. Let me just move out of the way. This is our heat map over the last month. You're seeing the right asset classes lead, right? We're seeing tech lead. We're seeing communication services lead, right? Apple with a big move over the last month. And we're seeing energy and some of the more defensive stuff, basic materials, and to a lesser degree, healthcare, they are starting to slow down and in energy's case pull back a little bit, right? So that is a good sign. If we want to see inflationary pressures peak, we need to see energy peak with that. So let's finish up with a look here at our retail investor, right? How are retail investors feeling? Even after a nice recent rally, we are still in the fear category on the fear and greed index. Investors are still not, they're unsure of this market. They're not sure if this is the real deal. And how can you blame them, right? We've had a lot of these false start rallies over the last 6 or 8 months. But again, under the hood and in the internals, this one does look a lot different to us. So we'll be watching the market momentum here, right, as we approach this orange line, our moving average, right? Can the market get above and stay above that moving average, which would be additional confirmation that this market is headed higher. So in summary, folks, we are starting to see very encouraging signs in this market. Again, it's a wait and see approach to this market. Market has to prove itself that it can continue higher from here. But we're starting to see the growth side of this market lead. And again, just to reiterate, we expect over the next 3 to 6 months, inflation is going to peak and the Fed's going to pivot. And if and or both of those things happen, a powerful rally will ensue. So if you have any questions, reach out to us. Always here to talk to you about the things that matter with your money. Hope you have a great day and a great rest of the week. And we'll see you back at our next Heritage Market Update. Take care.